Hi, welcome everybody. Thanks for being on time for this webinar. We're actually going to give some stragglers another minute or so to come on. So just hang tight for a second. We'll start in about a minute. Thank you. Okay, thanks everyone. Welcome to TBR's webinar series, and today we're going to hear from Principal Analyst John Caucis and from Analyst Brian Baker, who's going to talk about federal IT moves in the COVID environment and getting past COVID. So before we get started, a couple of housekeeping notes. The bottom of the screen, there's a series of buttons. You can access the slides, the audio controls, Q&A, our bios, all that kind of stuff, and a survey. And after the webinar, you're going to get an email with a replay link, as well as a link to view and register, of course, for other webinars. And you will actually get a link to the deck as well. So if you have questions during the webinar, please submit them via the Q&A widget. And you can also, of course, reach out to us afterwards. And again, thanks for joining us. And with that, I'll turn it over to John Caucis. John.
Great. Thanks a lot, Patrick. And thanks, everyone, for joining us today. My name is John Caucis. I'm the practice manager of our public sector IT services research program, joined by Brian Baker, who's an analyst on my team. And today we're going to walk through a preview. We're going to provide a preview of our upcoming public sector IT services benchmark, a report that we publish on a quarterly basis. And this report, which we'll publish next week, will cover the second calendar quarter of this year. We'll begin in a couple of minutes with a summary of the overall market trends that we observed as we tabulated the data from the most recent earnings season, particularly those driving revenue growth and profitability for the vendors that we track in our benchmark report. And just to provide a bit of backdrop here, we track, to one degree or another, 15 companies in the predominantly federal IT market and IT services market. We do look outside to the state and local markets a little bit to the international public sector, but our focus is really on the U.S. federal IT market. So after the summary, we'll shift to talking about the leaders, the vendors that made our leaderboard in terms of growth and profitability, and we'll provide details of the factors that were underlying their fiscal performance. And then we'll discuss the ongoing impact of the coronavirus pandemic on the federal IT market, as well as on the vendors providing technology services to federal agencies. So with that, if we could move to page 3, I'll begin talking about some of the trends that we saw with respect to growth. I'm sorry, slide 4. Okay. So let me take a minute to quickly orient everyone to the graphic here. What we plotted here are 3 views of growth for the aforementioned 15 companies in our public sector IT services benchmark. First, the weighted average year-to-year growth on a statutory or straight-line basis. Secondly, the weighted average year-to-year growth on a trailing 12-month basis, and the reason why we do this is primarily to smooth out the impacts, the effects of acquisitions, and this was particularly key over the last 2 or 3 years, and I'll explain why in a few minutes. And then third, we have plotted the weighted average year-to-year organic growth for the benchmark companies, which excludes the revenue from acquired companies during what we assume to be a 1-year integration process. So in other words, a company makes an acquisition that's relevant to their federal IT services business. We don't consider that acquisition to be fully integrated from a revenue standpoint until the 1-year anniversary of that acquisition. So, and then finally, we've also plotted our projections for growth for the upcoming third calendar quarter of the year. So the growth rates illustrated here, we've been observing them trend downward since the latter part of 2019. But the deceleration was due primarily to the impact of a handful of large-scale acquisitions that were approaching or had reached the aforementioned one-year anniversary and became fully integrated from a revenue standpoint into the acquiring company's revenue base. And we saw that we believe that this was predominantly the case rather than any kind of endemic slowdown in IT investment by federal agencies. In fact, as we turn the corner from 2019 to 2020 and really before the pandemic hit, in the latter couple of weeks of the first calendar quarter of the year, there was a lot of optimism of the market. There was the strong federal IT spending appeared poised to continue and 2020. And as we looked across the vendor set that we track, we saw record bookings, record backlog levels for many of the contractors that appear in our benchmark. But then the pandemic hit in as I mentioned, the latter weeks of the first calendar quarter of the year. The last 2 or 3 weeks of the quarter, rather, this was when we really started to see the impact. Most of the vendors that we track were saying that if they didn't make their growth projections, for example, it was because of what started to happen in the latter weeks of March. And what this had the effect of offsetting the lingering effects of strategic acquisitions that were made 2018, 2019, mostly in the rapid pipeline growth that many vendors had reported as the market moved from 2019 to 2020. We have still observed a fair amount of smaller scale M&A activity, and that remains a factor in the growth rates that we've illustrated here, but it's really been insufficient to counterbalance the effect of COVID-19, especially in the second calendar quarter of this year. Business development activities, project billings diminished, the volume of such diminished with the interruption that vendors and their agency counterparts were encountering as they had to shift large portions of their staff to telework, as well as they implemented new virtual collaboration tools and new governance mechanisms to maintain communications both internally and with their clients and project teams. I do want to make a couple of quick comments on the on M&A activity. The biggest contributors to any inorganic growth that is factored into the growth rates illustrated here come from SAIC and Leidos. They've been integrating about $4 billion in assets acquired over the last 2 to 3 quarters. And when you peg a number to this, this represents over 80% of any inorganic revenue that is included in the revenue base that we're tracking. So, in other words, in short, it's mostly on behalf of SAIC and Leidos. There have been a handful of other acquisitions. We'll mention that as we go through the presentation today. And these smaller scale purchases that we've seen, for example, Caucis' recent acquisition, technically in the third calendar quarter of the year, of AVT, Ascent Vision Technologies, Perspectivated acquisition, $53 million purchase of a company called DHPC Technologies to add electronic warfare and cybersecurity capabilities. But what seems to be more in vogue now, as opposed to in certainly 2018 and 2019, smaller scale purchases expand capabilities in niche areas rather than the large scale strategic acquisitions of the strategic variety. And COVID-19 added another caveat to all of that. Several of the companies that we track noted that even as they were looking at smaller scale acquisitions, and really everyone across the board said, yeah, we're still looking for potential acquisition candidates, but COVID-19 has introduced a lot more uncertainty, a lot more difficulty in terms of evaluating the valuations of potential acquisitions, and so we're kind of pumping the brakes on that for now. We've seen a handful, but nowhere near the volume, the pace of acquisition activity that we've observed, small scale or otherwise, over the last several years. So, coming into and kind of the pre-COVID-19 environment, we had expected a leveling off of growth rates, mostly due to the change in acquisition and M&A approach that I mentioned. But the erosion that we saw in growth rates, the deceleration, outpaced our expectations a bit, and the biggest factor behind this is, of course, COVID-19. The impact of the pandemic was concentrated during the second calendar quarter of the year. The tempo of operations at most federal agencies slowed in conjunction with their response to the pandemic. Most of the vendors that we track reported at least some direct or indirect pandemic-related erosion of sales growth and or profitability during the quarter. Some were compelled to lower their revenue margin targets for the current fiscal year, whether it's aligned with the calendar year or whether it ends sometime during calendar 20. But there was something else that emerged that was kind of interesting, which was that the outbreak was inconsistently impacting the vendors. A handful noted on the one hand that the impacts were less substantial than they had originally anticipated. Two that we'll talk about in more detail as we move forward, Mantech and Maximus. But there was also a disproportionate impact on the average growth rates for the vendors that represent the bulk of the revenue that we're tracking. Leidos is an example there. They have been a growth leader in our public sector IT services benchmark for several quarters. I'll get into the details as to what happened with Leidos, but also the defense-centric contractors like Raytheon. We track their intelligence and space segment. We track Northrop Grumman's defense systems segment, and we track, of course, GDIT, General Dynamics Information Technology. And the latter, GDIT, really stood out as a significant underperformer, and given the size of their revenue base, they really had a disproportionate impact on the average growth rates here. So a variety of impacts, more negative than positive. So with that, I'm just scanning my notes to see if I've missed anything here. So, but by and large, I did want to mention this as well. By and large, the vendors that we track were generally reporting that overall demand for IT modernization, national security-related solutions remained strong even with the interruption of COVID-19, even with the disruption of the pandemic, which they expected to begin to diminish during the third calendar quarter of 2020. Of course, this is the final quarter of the federal government's fiscal year. There was coming out of 2Q and going into 3Q, there was a lot of optimism that we might see, really a blockbuster quarter in terms of award activity and contracts awarded to the group of contractors that we follow. And we're, of course, going to be keeping that. That's going to kick off in about a month, a little less than a month from now, I think. And we're going to be keeping a very close eye on how the vendor set that we follow, how they did during what could be and what was shaping up to be based on the kind of the optimism that we were sensing. It could be one of the strongest quarters to close the federal fiscal year that we've seen in some time. So the expectations, those kind of qualitative expectations, we factored that into our projections for the upcoming quarter, which we've illustrated here, but we did so conservatively. Most of what you see here for the projected growth for the third calendar quarter of the year is driven by the quantitative guidance that we received from the vendors that we follow. So with that, let's move to the next slide where we'll focus, we'll kind of hone in on the individual leaders and laggards in terms of growth and profitability that we'll be talking in much more detail about in the upcoming report, which should publish once again next week. So I'll give everyone a minute to move forward, and then I'll take a minute or two to orient you to the graphic here. And what we're illustrating here, the 15 firms in the quarterly benchmark study, how they position against one another in terms of top-line growth, margin performance, operating margin performance, as well as the respective size of their revenue base. And the story here, in essence, who's growing the fastest and who's doing so most profitably. On the x-axis, we plot the absolute dollar growth of each vendor's federal IT services business. On the y-axis, we plot either the reported or the estimated operating margin for each vendor's the federal IT business. And then finally, the size of the bubble represents the volume of revenue generated during the quarter through federal IT services sales. I'll note also the weighted average year-to-year growth rate for the 15 firms, 4.0, plotted on the vertical dashed line, while the weighted average operating margin of 8.2 plotted on the horizontal dashed line. These averages are essentially set in stone. I don't anticipate any changes. We've more or less closed out the data gathering process, at least from a quantitative standpoint, for the quarter. So I expect that this will, in all likelihood, be the graphic that appears in our upcoming benchmark report. Obviously, with the impact of COVID-19, there was a decline. The same graphic in our previous benchmark report for the previous quarter, 1Q20, was 8%, declined to 4%. But conversely, the weighted average operating margin of 8.2% actually was up about 60 or so basis points from 7.6 in the prior quarter. And broadly speaking, we attribute that to really a rapid and effective responses on behalf of a majority of the vendors that we track from a resource management standpoint to the, as the pandemic hit. We saw our contractors really being aggressive in implementing, moving their workforces to remote environments, adapting the technologies to accommodate that, as well as working with their federal clients, to kind of show them how they did it and to help them along that path as well. So, and there was some pain. There was some staff calling that happened. Particularly with the defense-centric contractors, although a lot of that was related to their exposure to the aerospace industry. But conversely, other contractors, and I know Brian's going to talk about this in a few minutes, like Mantech, they continued to hire aggressively. Other contractors said that even though they had to shift recruiting and the evaluation of interns for upcoming summer internship programs that weren't canceled, even though they had to shift that to more of a virtual format, that they were still looking for a base of interns and as well as new hires because they expected that the rebound would be fairly quick and would be fairly aggressive once the market moved past COVID-19. So, let's shift to talking more specifically about the growth and margin leaders. And I do want to make a couple of comments before I hand the presentation off to Brian. He just happens to track many of the growth leaders, so I thought it would be a good place to start. As of our last benchmark report in the first calendar quarter, we made an addition to the subset of companies in federal IT that we track. And what we did was we added Maximus in place of Unisys. This was because of Unisys Federal being acquired by SAIC, and we didn't think that even though they retained a focus on the state and local market, we expect that they may, in fact, divest that at some point in the near future, at which time we would have to go through the entire process of removing them from our quantitative models. So we had been getting more questions. There had been more interest in the market, at least within our client base, about Maximus, and so it was really a no-brainer for us to make the shift and replace Unisys with Maximus. So that happened last quarter. They're fully integrated into our benchmark now. In fact, they were the growth leader during the second calendar quarter of the year. So for additional comments around that, I'm going to hand the presentation to Brian, who also is our lead analyst tracking Mantech, SAIC, and CACI, as well as Perspecta, and he'll have comments across the board for those vendors. So, Brian, take it away.
Great. Thanks, John. Yeah, so I'll start with our growth leader, Maximus, which posted higher than 55% year-to-year federal revenue growth in 2Q20. That was thanks largely to the expansion of the Census Bureau contract that came to Maximus through its acquisition of the GDIT call center business, which won the contract originally in 2016. That contract alone contributed $140 million to federal revenue for Maximus in 2Q20, which was about 31% of their total federal revenue. It should also be noted that at this point, that revenue is entirely organic, at least how we calculate it, because the GDIT call center acquisition was more than a year ago, so it is considered to be fully integrated from a revenue standpoint. Maximus has also done pretty well to capitalize on opportunities with health agencies in helping them deal with their response to COVID-19. Moving on to ICF, who's the next growth leader. They saw a 21% growth in federal revenue, mostly due to their acquisition of ITG, which added a TBR estimate of about $33 million in 2Q20 revenue. And we believe that over the next year or two, ICF is well positioned to capitalize on the increase in public health preparedness and response activities that are likely to continue to take place across all levels of government. And they have a solid presence across a number of agencies that deal with public health preparedness and response. Mantech, their revenue grows nearly 18% year to year in 2Q20, which was actually more than double my initial forecast for their growth for the quarter. And that's almost entirely organic, since we now consider KGS to be fully integrated from a revenue standpoint. So H2M Group is the only inorganic contribution in 2Q20, and that only contributed about 1.3 percentage points to that total 17.8. Classified customers continue to accelerate spend with Mantech despite the pandemic, and Mantech has also been able to aggressively hire through the entire year. And they've been able to really quickly scale new engagements and execute on the key classified contracts that have really driven them to continued growth. Mantech also has made investments heavily into cybersecurity space and more recently into health. And that's proven to be very prescient, and it's really allowed it to grow in a situation where a lot of their peers have struggled a bit to maintain their existing operations. Move on to SAIC, which SAIC's position on the growth leaderboard there is pretty much entirely due to the inorganic revenue from Unisys Federal, which is about $189 million in 2Q20, and the company only grew about $170 million on a statutory basis. So they're without Unisys Federal, they would be, I believe, fifth on the from the back on the growth leaderboard there at about -1%. CACI also had a very strong quarter. Their growth has been driven by new business wins and on contract growth, in addition to some smaller inorganic contributions from quite a few companies they've acquired in the last few years, but none contribute that much. Organic growth was nearly 8%, while total growth was about 9%. CACI also noted on its last earnings call that acquisitions will remain the top priority for capital deployment for them through the rest of the year. So they just acquired AVT, like John mentioned earlier, in the third quarter. I wouldn't be surprised to see them make additional acquisitions later in 2020 or the end into 2021. Lastly, I'll mention Perspecto was our margin laggard in the quarter, and they delivered pretty much flat revenue growth for the quarter. They were heavily impacted by the COVID-19 pandemic, in addition to some legacy contract runoffs, despite the inorganic benefits from their two most recent acquisitions, Nightpoint Systems and DHPC. The company noted its margins are being pressured most significantly by COVID-19, shifting contract mix, and a lower asset intensity. And the company's guidance and outlook for the remainder of the year remains stable despite that performance, and also includes the expected continued impact from the pandemic and their loss of Engine, which currently accounts for about 18 to 19% of their total revenue, and will continue to do so at least through the rest of the year. John, unless you have any additional comments on those, I'll give it back over to you.
Okay, great. Thanks, Brian. I'll make a few comments on three more of the growth leaders on our upcoming benchmark report, Accenture Federal Services, or AFS, Booz Allen Hamilton, and Leidos. Beginning with AFS, and they continue to perform well in our benchmark, and their performance is, we chalk that up to their extensive suite of offerings. They've honed on the commercial markets and have, in many cases, repurposed for the federal IT space. And these solutions enabling clients, federal agency clients, to optimize, modernize their IT infrastructures with AI, automation, cloud, analytics-based tools. They did win several awards during the quarter that had an impact on revenue. Civilian and defense clients, which we calculate about an aggregate value, at least the awards that we were aware of, an aggregate value of roughly $500 million in the second calendar quarter of the year. Department of Commerce, the VA, overseas with the Department of Defense in Australia, which doesn't really come into play here, but they are gaining traction overseas as well. And COVID-19 notwithstanding, one of the things that really caught our attention was how Accenture wasn't really taking their foot off the gas, and they opened a new advanced technology center in the St. Louis area, where they expect to employ about 1,400 people over the next 5 years to support, I believe, predominantly their federal IT business. And this hub will further expand. It will add another center to their existing network in the U.S., which includes, for example, their cyber center, federal cyber center in San Antonio, an advanced technology center in the D.C. area, specialized centers in Niagara Falls and Chesapeake, Virginia. And Accenture also continues to successfully leverage their digital studio in the D.C. area to drive new sales, evidenced by the $50 million blanket purchase agreement with the Patent and Trademark office that they won to provide automation and innovation support services. Moving then to another advisory-led company, Booz Allen Hamilton, they finished the quarter as a growth leader, and this quarter marks 20 consecutive quarters of year-to-year expansion on both a statutory and organic basis. They haven't made an acquisition of any kind since the latter part of 2017. So for me, this is really it makes their growth, their consistent growth, their consistent top line growth that much more impressive from my standpoint. They have been encountering some challenges recruiting cleared staff in the intelligence sector, but in their defense and their core defense and civilian business, things are still moving along quite strongly. Civilian was the strongest sector for Booz, 13% year-over-year growth, but their defense business also booked over $900 million in new programs featuring their expanding portfolio of advanced solutions, particularly in the analytics. Booz does operate a small commercial business, which was surprisingly up, but that business has really been choppy in terms of its performance over the last couple of quarters. However, we will note that they're parlaying their expertise in cybersecurity to drive more consistent performance in their, albeit small, I think it's less than 3 or 4% of their total revenue base, their small commercial business. Booz Allen's backlog rose, reached a new record high during the quarter, over $23 billion. Quarterly book-to-bill was 2.2, which was way up from 0.4 in 1Q20. And I'll also note that this is the highest book-to-bill ratio that we've observed for this particular quarter, which doesn't tend to be one of their strongest quarters, historically speaking, from a booking standpoint. I'll also mention that Booz was one of the most aggressive companies in terms of responding to the pandemic. They initiated a $100 million fund to support their employees. They were particularly aggressive in stabilizing their partnership network. They moved, I think, over 90% of their workforce to telework very, very quickly. And even though their sales were impacted slightly, the impact was really mitigated, by how quickly they were able to. And I think that this certainly speaks to Booz having a much greater level of maturity with operating in this fashion than perhaps some of their immediate peers. So finally, Leidos, who has been, as I mentioned earlier, a long-standing, particularly over the last year or so, long-standing leader in our public sector IT services benchmark in the federal market in terms of growth, in terms of the size of the revenue base. They certainly weren't taking their foot off the gas with the acquisitions of Dynetics earlier this year, which had an impact certainly this quarter. In the second quarter of this year, as well as the assets, the automation and security business that they bought from L3Harris. Robust new bookings, record backlog, but concentrated on the defense and civilian segments of Leidos, each of which realized double-digit year-over-year growth. Now, they did underperform in terms of our expectations. I think that their overall sales were up around 6%. I would have to double check that, but the point being that the biggest headwind that they saw was in their healthcare business. Not surprisingly, with the impact of the pandemic, they've established healthcare as a strategic growth market, and the health business had been delivering quarter after quarter after quarter. I think 5 of the last 6 quarters, up until the second quarter of this year, the Leidos Health had delivered double-digit growth, or the one-off quarter was still high single-digit growth. So I think it really exemplifies the impact of COVID-19 on a vendor who does have a large, fast-growing healthcare business. We know, for example, they had trouble getting their project teams on site to their healthcare IT clients as a result of the pandemic. They haven't given any indication that they see that kind of ebbing over the next quarter, but we expect that. I mean, their healthcare business was down 20% during the quarter. We don't expect that that's going to happen again. So, but their defense and civilian business continued to move forward very, very nicely. Quick mention of the margin leaders. Some of the folks we've talked about already. 2 additional companies, Northrop Grumman's Defense Systems Group, who has they've been a long-standing margin leader in our benchmark. They did accrue some one-time short-term expenses associated with the operational modifications they made to respond to COVID-19, but they continue, and they offset much of that by continuing to drive operational efficiencies that they've realized from their recent reorganization, as well as sustained contract delivery, optimizing contract delivery, which has been an increasing focus of theirs over the last year. It certainly has accelerated with their recent reorganization. CGI Federal also is another longtime margin leader. Their margins were eroded somewhat, even though I think they were at the top of our leaderboards this past quarter, even with the costs, the accumulating costs of their recent acquisition of TerraThink, which I believe happened in the March time frame. But CGI continues to gain traction with their homegrown IP-rich solutions, particularly in cybersecurity. So they tendered another strong showing during the second quarter of the year. So with that, I want to make some final comments and then leave 10 or 15 minutes for any Q&A. I would like to make some final comments right now about more COVID-19 specific and what we observed in terms of the market, what we observed in terms of the vendors responding to the impact. So if we could please move to slide 7. All right, thank you. So as the outbreak arrived and spread, we saw vendors transitioning. In some cases, I mentioned Booz Allen Hamilton earlier, but they weren't alone in moving 80 to 90% of their workforces to a distributed work environment. And in general, most of the contractors, even the contractors that underperformed in terms of growth and profitability, most of the contracts that we track were able to adapt quickly to a predominantly telework and remote service delivery environment, predominantly telework and remote business development environment. Those with a more capital or asset-light operating model, in other words, those that have more long-standing telework policies in place, seem to be able to achieve that more quickly. And we're really getting the sense that distributed project teams operating in safe work environments is going to become the new normal in operations. We think this is going to remain in place at least to a greater degree than before COVID. As the market moves beyond the end of the federal fiscal year, and it's really going to be a telling quarter. And as I mentioned earlier, something that we're anxiously anticipating to see. What was the impact, and how did things end up playing out during what is typically the busiest quarter of the federal fiscal year. We saw vendors rapidly ramping up digital solutions and introducing them to their clients to accommodate their concurrent need to shift to a mostly telework environment and the need to adopt more robust virtual collaboration tools. For the contractors in our benchmark that have more consulting expertise or more of a consulting-led model, they were seeing more work coming in, helping their agency clients amend resource management policies, in some cases in the form of IT-augmented advisory services. And as is the case, I believe, or as is going to be the case on the vendor side, several of the agencies that were mentioned by the contractors we track as having plans to keep large portions of their workforces off-site even after the pandemic subsides. So that's going to create challenges, resource management challenges, adapting more edge computing and secure edge computing solutions to enable that portion of their workforces to work remotely in the post-pandemic federal IT sector. I'd like to also mention that the vendors we track really honed in on managing their subcontractor network, their network of suppliers, citing that this was really critical to ensure that their key partners, irrespective of size, in many cases, remain buoyant, stable, and secure, and B, that the prime contractors themselves were able to continue doing what they were doing with minimal interruption. And we see evidence that was the case, mostly in the form of the vendors that reported that the impact of COVID-19. And many vendors kind of took more of a pessimistic view, but then as Maximus is a good example. They stopped providing guidance within a couple of weeks of the pandemic, really becoming a factor in March, and then they reissued their guidance shortly thereafter, much sooner than anyone had anticipated. So. They weren't the only ones. They may have been more on one end of the spectrum, but they weren't the only contractor to report having adapted to the environment very, very quickly. Unfortunately, though, the coronavirus is still active. There's been no proven comprehensive treatment or vaccine available, and no real way of predicting its future path. And this is factoring into some lingering pessimism on behalf of the vendors that we track. Government entities are still going to face budgetary pressures. This may be exacerbated at the state and local level, where budgets are more limited. There's more pressure. It may drive an acceleration in digital modernization, or it may cause agencies to be state level agencies to be more picky and choosy with what where they're going to spend their dollars. But at the federal level, it appears as that certainly through the remainder of fiscal 20, which ends today, coincidentally, mostly because the spending commitments were already in place. But even as we move into federal fiscal 21, the outlook is that modernization, digital transformation is going to remain a priority across the board. But beyond what we have seen in a handful of instances, excuse me, is that beyond the federal fiscal 21, we may start to see the deficit pressures emerging, as well as the need to continue to shore up disaster preparedness, disaster response, to technology, to IT enhance those capabilities, to divert more budget funds away from currently well-funded defense, intelligence, and space programs over to the civilian side, over to the healthcare-related agencies. So the vendors with larger operations, obviously in the intelligence community or in classified programs, may be disproportionately impacted. Certainly on the DoD side, may be disproportionately impacted at that time. But that's one of the unknowns that the vendor set that we follow is kind of contending with right now. Brian mentioned this earlier. I'm going to concur that we do expect to see a sharp increase in initiatives around enhancing public health preparedness, response activities across the board, federal, state, local levels, even internationally. Vendors will aggressively pursue new contract vehicles with agencies involving pandemic response. Winning vendors are going to have the strongest records of past performance. I don't think that that's going to change at all. This is something that really distinguishes Leidos, for example, in the market. Being able to cite strong past performance as a differentiator. Modernizing disease surveillance systems, advanced analytics, companies like AFS and a company that's kind of outside our benchmark, but Deloitte Federal and Booz Allen Hamilton. We know this is an area where Leidos is also looking as well, utilizing advanced analytics to enhance disease surveillance systems. We see that as being prioritized in agency budgets. And really in concert with the overall drive of towards IT modernization and digital transformation, we believe that agencies at all levels are going to take a closer look, maybe step back and say, do we need to reassess our operations, our governance frameworks to improve future response capabilities, not just from a technology standpoint, but do we need to rethink how and where work is getting done? And we see this generating more opportunities for vendors with the ability to consult on operations and change management, and then being able to technology enable that with analytics, with AI, machine learning, data science, and immersive technologies, not only to accommodate the social distancing requirements, but to optimize both customer citizen engagement as well as employee engagement. So with that, I see that we're at quarter to the hour. I will stop there. There is certainly going to be additional information available in the upcoming benchmark. I'll also note that we recently published a white paper with more granular view of our observations of the market as it moved, the federal IT market as it moved out of the COVID-19 environment, which, as I mentioned, was really predominantly impacted the market during the second quarter of the year. Please reach out to us if you haven't seen that white paper. And with that, I'll open things up for questions. So.
Excellent. John, I have a question. So you mentioned on the slide talking about COVID that changing the way that these vendors are managing their partner ecosystems. Could you talk about that a little bit more, like where you see some of the most important changes coming from, and are there certain particularly technology partners that you think they're going to need to work differently with going forward?
Cybersecurity seemed to be the overarching theme. Making sure that that partners had, even if they did have robust measures in place, making sure that they were up to date, making sure that if there was the need for modernization or enhancement, that was happening. I think in some cases, it was kind of a push model where the primes with the longest standing operations in cybersecurity, providing defense-grade cyber, for example, they were more proactive in going out to the market and saying, let's make sure that your supply chains are secure, because this can affect everyone up and down, the entire chain. So that was really the biggest focus in terms of technology. There were some vendors that set up funding apparatuses to provide any kind of support, financial support to partners that may be struggling in some key areas. But that, I think, took a backseat to more the technology focus, certainly the cyber security focused help that they or guidance, advice that they were giving.
Yeah, that makes sense, and we saw that in the commercial side as well, which raises another question for me. One thing we saw during the pandemic was a spike in demand for cloud solutions and cloud migration, again on the commercial side and from the commercial-focused IT services vendors. Has there been a similar spike in demand for cloud solutions in this public sector space?
Yes and no. Given that the federal space is still several years, I think, behind the commercial sector in the embrace of cloud technologies, the demand is there. I don't think that the level of demand changed, but where there was an increase was in the recognition that we've got to do this and we've got to accelerate things. So this kind of gets back to my earlier point about, do we need to take a look, for example, do we need to revamp, do we need to revise procurement, the entire procurement process to speed things along? And there's really two camps there. There's one camp that says, once COVID subsides, that things are just going to go back to normal because there's not enough. There's just not as many evangelists for procurement reform. And then the other camp is that yes, this is going to drive more procurement reform. We might see this outside the U.S. or we might see this in the state markets before we see it in the federal market. But the recognition that cloud has to happen. COVID-19 just underscored that, really.
Yeah, that's helpful, and that's not too surprising. You mentioned procurement, which brings up another question for me. We recently heard a great presentation from EY talking about blockchain and how they have a solution that does a lot to help the procurement. Of course, it requires working in an ecosystem kind of play. So, but just questioning whether or not blockchain is something you're starting to see or have seen in the public sector space as well.
Really, only on behalf of a handful of vendors, and they seem to be the ones, at least from my limited view of the commercial side, that were out ahead of this or had more mature capabilities. Folks like IBM, Accenture, the more consulting led. I think Booz Allen may have some solutions there, although they really seem to be honing in on AI analytics. But I haven't seen a lot of activity. It's not to say that it's not happening, but of course our view is through the lens of the 15 companies that we follow, and within that sphere of companies, I haven't yet seen, there's been more talk than action in terms of blockchain.
And in your opinion then, is it something that is likely to change in the near term, or you think it's probably going to stay just sort of a more talk than action kind of situation? Or do you anticipate that there'll be a ramp up, particularly coming out of this pandemic?
I think this is a longer-term horizon, and the security question is going to have to be addressed thoroughly. I know that they're on the commercial side that's been somewhat of a concern, but it's going to be without question a strategic level concern on the across the federal market.
Okay, and no more questions in the queue, so I think that's it. Is there any last closing comments, Brian or John?
No, I'd just like to thank everyone for joining us today. I hope this was helpful. We are, of course, available for additional follow-up questions. You can email us directly. Our email addresses are here. Brian, did you have anything else before we wrap up?
No, thanks very much.
Yep, thanks again, everybody. You will be getting a chance to take a survey on this webinar, and then there are, of course, more webinars coming up. And we're about to move into the season where we put out our predictions as well. So look for John and Brian to come back probably sometime later this year, towards the end of the year, to look for their predictions on what we're going to see in 2021. Thanks, everybody, and take care.